Hello viewers, in this lesson we will learn about the non-banking financial companies. Objectives. To learn about the meaning, definition and activities of non-banking financial companies. To learn about the application of various legislations to non-banking financial companies. This lesson explains the various issues relating to the non-banking financial companies. Viewers, now we will learn about the meaning, definition and activities of non-banking financial companies. Meaning. Non-banking financial companies, called in short NBFCs, are those companies which carry finance business without carrying banking business. That means those are not banking companies. The banking companies carry both banking and finance business apart from discharging multidimensional functions, whereas the NBFCs carry only finance business as main objective or one of the main objectives. The NBFCs are playing a very pivotal role in finance business apart from the banks, and these companies are making a very significant contribution for the growth of the Indian economy. For this reason, several safeguards are ensured for the protection of the investors by the governments through various legislations. According to the Reserve Bank of India, a non-banking financial company is a company registered under the Companies Act 1956, engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authority or other marketable securities of a like nature, leasing, hire purchase, insurance business, cheat business, but does not include any institution whose principal business is that of agricultural activity, industrial activity, purchase or sale of any goods other than securities, or providing any services and sale, purchase, construction of mobile property. A non-banking institution which is a company and has principal business of receiving deposits under any scheme or arrangement in one lump sum or in installments by way of contributions or in any other manner is also a non-banking financial company, that is residuary non-banking company. Here, financial activity as principal business is when a company's financial assets constitute more than 50% of the total assets and income from financial assets constitute more than 50% of the gross income. A company which fulfills both these criteria will be registered as NBFC by RBI. The term principal business is not defined by the Reserve Bank of India Act. The Reserve Bank has defined it so as to ensure that only companies predominantly engaged in financial activity get registered with it and are regulated and supervised by it. Hence, if there are companies engaged in agricultural operations, industrial activity, purchase and sale of goods, providing services or purchase, sale or construction of immobile property as their principal business and are doing some financial business in a small way, they will not be regulated by the Reserve Bank. Interestingly, this test is popularly known as 50-50 test and is applied to determine whether or not a company is into financial business. NBFCs lend and make investments and hence their activities are akin to that of banks. However, there are a few differences as given below. 1. NBFC cannot accept demand deposits. 2. NBFCs do not form part of the payment and settlement system and cannot issue checks drawn on itself. 3. Deposit insurance facility of deposit Insurance and Credit Guarantee Corporation is not available to depositors of NBFCs, unlike in case of banks. Statutory definition. Section 45H2, 45QB of the Reserve Bank of India Act 1934 contain the relevant provisions on the NBFCs. Clause F2, Section 45(1) of the Reserve Bank of India Act 1934 defines the non-banking financial company. According to this provision, non-banking financial company means 1. A financial institution which is a company. 2. A non-banking institution which is a company and which has as its principal business the receiving of deposits under any scheme or arrangement or in any other manner or lending in any manner. Such other non-banking institution or class of such institutions as the bank may, with the previous approval of the central government and by notification in the official gazette, specify. With regard to the receiving of deposits referred to afore, the Supreme Court in Peerless General Finance and Investment Company Limited versus Reserve Bank of India reported in 1987, 1 SCC 424, held that in order to be a deposit within the meaning of the term as defined, a receipt of money must carry with it the corresponding obligation to repay the same. Further, it was observed that all non-banking institutions which carry on the activities mentioned in the various clauses of Section 45IC, whether they carry on the said activities on their main business or part of their business, come within the purview of being the financial institutions. Here, there is a distinction between a non-banking institution and an NBFC. An NBFC must be necessarily a company. Under Section 45IAA of the RBI Act, a company means a company registered under the Companies Act and includes a foreign company. Under Section 45IE of the Reserve Bank of India Act, a non-banking institution means a company, a corporation, or a cooperative society. Under Section 45IB of RBI Act, a corporation means a corporation incorporated by an act of any legislature. Any society registered under the Cooperative Societies Act, whether central or state, is a cooperative society. A banking company is one as defined under Clause C of Section 5 of the Banking Regulation Act 1949. Thus, a non-banking institution includes an NBFC, and a reference to NBFC is exclusively to a company. A company is treated as a financial institution if it attracts the parameters laid under Clause C to Section 45I of the RBI Act. The whole concept of NBFCs centers around non-banking financial business. Thus, Clause A of Section 45I of the RBI Act defines the business of a non-banking financial institution as carrying on the business of a financial institution referred to in Clause C and includes business of a non-banking financial company referred to in Clause F. Clause C defines a financial institution as follows. Financial institution means any non-banking institution which carries on as its business or part of its business any of the following activities, namely, 1. The financing, whether by way of making loans or advances or otherwise, of any activity other than its own. 2. The acquisition of shares, stock, bonds, debentures or securities issued by a government or local authority or other marketable securities of a like nature. 3. Letting or delivering of any goods to a hirer under a hire purchase agreement as defined in Clause C of Section 2 of the Hire Purchase Act 1972. 4. the carrying on of any class of insurance business. 5. Managing, conducting, or supervising as foreman, agent, or in any other capacity of chits or couriers as defined in any law which is for the time being in force in any state or any business which is similar thereto. 6. Collecting for any purpose or under any scheme or arrangement by whatever name called, monies in lump sum or otherwise, by way of subscriptions or by sale of units or other instruments or in any other manner, and awarding prizes or gifts, whether in cash or kind, or disbursing monies in any other way to persons from whom monies are collected or to any other person, but does not include any institution which carries on as its principal business agricultural operations or industrial activity, or the purchase or sale of any goods other than securities, or the providing of any services, or the purchase, construction, or sale of immobile property, so however that no portion of the income of the institution is derived from the financing of purchases, constructions, or sales of immobile property by other persons. As per the explanation given in this section, for the purpose of this clause, industrial activity means any activity specified in subclauses 1 to 18 of clause C of section 2 of the Industrial Development Bank of India Act 1964. Different types, categories of NBFCs. According to the Reserve Bank of India, NBFCs are categorized A. in terms of the type of liabilities into deposit and non-deposit accepting NBFCs. B. Non-deposit taking NBFCs by their size into systematically important and other non-deposit holding companies, NBFC, NDSI and NBFC ND. And C. by the kind of activity they conduct. Within this broad categorization, the different types of NBFCs are as follows. Asset Finance Company, AFC. An AFC is a company which is a financial institution carrying on as its principal business the financing of physical assets supporting productive economic activity such as automobiles, tractors, lathe machines, generator sets, earth moving and material handling equipments, moving on own power and general purpose industrial machines. Principal business for this purpose is defined as aggregate of financing real physical assets supporting economic activity, and income arising therefrom is not less than 60% of its total assets and total income respectively. Investment Company, IC. IC means any company which is a financial institution carrying on as its principal business the acquisition of securities. Loan Company, LC. LC means any company which is a financial institution carrying on as its principal business the providing of finance, whether by making loans or advances or otherwise for any activity other than its own, but does not include an asset finance company. Infrastructure Finance Company, IFC. IFC is a non-banking finance company, A, which deploys at least 75% of its total assets in infrastructure loans. B, has a minimum net owned funds of rupees 300 crore. C, has a minimum credit rating of A or equivalent. D, and a CRAR of 15%. Systematically important core investment company, CIC NDSI. CIC NDSI is an NBFC carrying on the business of acquisition of shares and securities which satisfies the following conditions. It holds not less than 90% of its total assets in the form of investment in equity shares, preference shares, debt or loans in group companies. Its investment in the equity shares, including instruments compulsorily convertible into equity shares within a period not exceeding 10 years from the date of issue, in group companies constitute not less than 60% of its total assets. It does not trade in its investments in shares, debt or loans in group companies, except through block sale for the purpose of dilution or disinvestment. It does not carry on any other financial activity referred in section 45IC and 45IF of the RBI Act 1934, except investment in bank deposits, money market instruments, government securities, loans to and investments in debt issuances of group companies or guarantees issued on behalf of group companies. Its asset size is rupees 100 crore or above. It accepts public funds. Infrastructure Debt Fund. Non-banking financial company IDF NBFC. IDF NBFC is a company registered as NBFC to facilitate the flow of long-term debt into infrastructure projects. IDF NBFC raise resources through issue of rupee or dollar denominated bonds of minimum 5-year maturity. Only infrastructure finance companies, IFC, can sponsor IDF NBFCs. Non-banking financial company, microfinance institution, NBFC MFI. NBFC MFI is a non-deposit taking NBFC having not less than 85% of its assets in the nature of qualifying assets which satisfy the following criteria. Loan disbursed by an NBFC MFI to a borrower with a rural household annual income not exceeding rupees 1 lakh or urban and semi-urban household income not exceeding rupees 1,60,000. Loan amount does not exceed rupees 50,000 in the first cycle and rupees 1 lakh in subsequent cycles. Total indebtedness of the borrower does not exceed rupees 1 lakh. Tenure of the loan not to be less than 24 months for loan amount in excess of rupees 15,000 with prepayment without penalty. Loan to be extended without collateral. Aggregate amount of loans given for income generation is not less than 50% of the total loans given by the MFIs. Loan is repayable on weekly, fortnightly or monthly installments at the choice of the borrower. Non-banking financial company factors, NBFC factors. NBFC factor is a non-deposit taking NBFC engaged in the principal business of factoring. The financial assets in the factoring business should constitute at least 50% of its total assets, and its income derived from factoring business should not be less than 50% of its gross income. Mortgage guarantee companies, MGC. MGCs are financial institutions for which at least 90% of the business turnover is mortgage guarantee business, or at least 90% of the gross income is from mortgage guarantee business, and a net owned fund is rupees 100 crore. NBFC, Non-Operative Financial Holding Company, NOFHC. This is a financial institution through which promoter groups will be permitted to set up a new bank. It's a wholly owned non-operative financial holding company which will hold the bank as well as all other financial services companies regulated by RBI or other financial sector regulators, to the extent permissible under the applicable regulatory prescriptions. The students are advised to study further the NBFC's Acceptance of Public Deposits, RB Directions 1998, and other circulars, orders of central government, RBI, as amended, modified from time to time. Viewers, now we will learn about the application of various legislations to non-banking financial companies. The NBFCs have to comply with the provisions of several acts, directions of RBI, which are narrated hereunder. 1. The Reserve Bank of India Act 1934. Sections 45H2, 45QB contain various provisions pertaining to the regulation of the NBFCs. Further, Sections 58B to 58G contain the penal provisions for imposing penalties for violation of the provisions of the RBI Act by the NBFCs and other persons. Under Section 45IA, every NBFCs must be compulsorily registered with the RBI and hold the net owned fund of 25 lakh rupees or such other amount not exceeding 200 lakh rupees as the RBI may specify by a notification. The detailed procedure is stipulated for registration under the provisions of Section 45IA of the RBI Act. The RBI under Section 45IA can cancel the certificate of registration if the company ceases to carry the business or it has violated the conditions or the provisions of the Act. Section 45IB pertains to the maintenance of percentage of assets. The powers of the RBI are narrated under Section 45JA, 45K, 45L, 45MB, 45MC, 45N and 45NC. Sections 58B to 58G contain the provisions on levying penalties for violation of the provisions of the Act. The RBI is empowered to levy the penalty under Section 58G for the contravention or the default of the nature referred to in Section 58B committed by an NBFC. Under Section 58E, to take cognizance of any offence punishable under this Act, a complaint must be given in writing by an officer of RBI authorized in this regard, and no court other than that of a metropolitan magistrate or a judicial magistrate of the first class or a court superior thereto shall try any such offence. 2. The following acts and directions are also applicable to the NBFCs. The Price Chits and Money Circulation Schemes Banning Act 1978. The Chit Funds Act 1982. The NBFC's Acceptance of Public Deposits RB Directions 1998. NBFC's Prudential Norms Reserve Bank Directions 1998. Miscellaneous NBFC's RB Directions 1977. Residuary NBFC's RB Directions 1977. NBFC's Auditors RB Directions 1998. Know Your Customer Guidelines for NBFCs. As per the guidelines of the RBI, the depositors must take the following precautions before placing their deposits with an NBFC. That the NBFC is registered with RBI and specifically authorized by the RBI to accept deposits. NBFCs have to prominently display the certificate of registration, COR, issued by the Reserve Bank on its site. This certificate should also reflect that the NBFC has been specifically authorized by RBI to accept deposits. The maximum interest rate that an NBFC can pay to a depositor should not exceed 12.5%. The Reserve Bank keeps altering the interest rates depending on the macroeconomic environment. The depositor must insist on a proper receipt for every amount of deposit placed with the company. In the case of brokers, agents, etc., collecting public deposits on behalf of NBFCs, the depositors should satisfy themselves that the brokers, agents are duly authorized by the NBFC. The depositor must bear in mind that public deposits are unsecured and deposit insurance facility is not available to depositors of NBFCs. The Reserve Bank of India does not accept any responsibility or guarantee about the present position as to the financial soundness of the company or for the correctness of any of the statements or representations made or opinions expressed by the company and for repayment of deposits, discharge of the liabilities by the company. Well, viewers, I hope you have enjoyed this lesson. We'll meet again. Thank you.